I want you to stop whatever you are doing right now and give me the next 30 minutes. Because what I am about to share with you is not a theory. It is not speculation. It is not some YouTube fear tactic designed to get you to click on the next video. What I am about to walk you through is the actual, real-time thinking of one of the most successful investors in the history of American finance. A man who has never had a losing year in 3 decades of managing money. And he is saying, with more urgency than he has expressed in years, that the window to protect yourself is closing fast. Stanley Druckenmiller has moved his money. He has already repositioned. He has already made the adjustments that most people are still debating whether they need to make. And the gap between what he sees coming and what the average American with a retirement account understands about their own risk, that gap is enormous right now. And it is dangerous. Here is the brutal truth that nobody on Wall Street wants to say clearly. If you are sitting in the same portfolio you were sitting in 2 years ago, the same mix of stocks and bonds, and maybe a little cash, you are carrying risk that you probably do not fully understand. The environment has changed. The rules have changed. The playbook that worked for the last 40 years is running out of road. And the people who do not adjust before the crash are the ones who spend the next 5 to 10 years trying to recover what they lost. Instead of enjoying the retirement they worked their entire life to build. Druckenmiller is not telling people to panic. He never panics. Panic is for amateurs. What he is saying, and what I am going to show you in detail today, is that there are 3 specific places you can move your money right now that will protect it from what is coming and potentially allow it to grow even as the broader market struggles. 3 places that Druckenmiller himself has positioned toward. 3 places that have historically performed well in exactly the kind of economic environment we are entering right now. Stay with me through this entire video. Do not skip ahead, because the context matters enormously. If you do not understand why the crash is coming, you will not be confident enough in the solution to actually act on it. And acting on it, actually moving your money, is the only thing that will make a difference. Let's start with the foundation. Why does Druckenmiller believe a significant market correction or crash is coming? And why is 2026 specifically the window he is focused on? To understand this, you need to understand how Druckenmiller thinks about markets. He is not a stock picker. He is not sitting in a room analyzing quarterly earnings reports. He is a macro investor, which means he studies the massive forces that move entire economies: interest rates, currency values, government debt levels, geopolitical shifts, credit cycles. He looks at the big picture and then figures out where to position capital to benefit from what that big picture is telling him. And the big picture right now is telling him something very specific. The United States has spent the last 15 years in an artificially created economic environment. After the 2008 financial crisis, the Federal Reserve took interest rates to essentially zero and kept them there for over a decade. They also created trillions of dollars out of thin air through a process called quantitative easing. Buying government bonds and mortgage-backed securities to pump liquidity into the financial system. That flood of cheap money inflated the prices of almost every asset class. Stocks went up, bonds went up, real estate went up, private equity went up. Everything went up because money was essentially free, and there was nowhere else to put it. That era is over. The Federal Reserve raised interest rates aggressively starting in 2022 to fight the inflation that all that money printing eventually caused. And now we have a situation where the economy is trying to function with interest rates that are dramatically higher than anything we have seen since before the financial crisis, and doing so while carrying a government debt load of over $35 trillion that was accumulated largely during the era of zero rates. The interest payment alone on that debt is now over $1 trillion per year. $1 trillion a year just to service the debt. That is more than the entire defense budget. More than Social Security payments. Just the interest. Druckenmiller has called this fiscal situation the most reckless in the history of the country. He has said in interview after interview that this level of debt, combined with an aging population and the entitlement commitments of Social Security and Medicare, creates a structural deficit that is essentially unfixable without either massive spending cuts, massive tax increases, or massive inflation. None of those options are painless. All of them are disruptive to financial markets in significant ways. Now layer on top of that fiscal disaster the tariff situation. As we discussed in previous videos, the tariff program being implemented right now is the most aggressive trade intervention since the 1930s. Tariffs are inflationary. They raise the price of imported goods, and inflation on top of an already strained fiscal situation. In an economy where the consumer is stretched thin and the Federal Reserve has limited room to maneuver, is the recipe for the stagflationary crisis Druckenmiller has been warning about. The reason 2026 is a specific flashpoint is about timing and triggers. The full economic effect of the tariffs takes 6 to 18 months to fully work through the supply chain and show up in consumer prices and corporate earnings. We are in that window right now. The debt ceiling drama that plays out every year in Washington is reaching a critical inflection point. The commercial real estate market, which has been quietly deteriorating since remote work emptied office buildings, is facing a massive wave of refinancing at much higher interest rates than the loans were originally written at. Regional banks are carrying those commercial real estate loans on their books. And the stock market is still priced in many segments as though the era of free money is coming back. It is not coming back. And when the market fully prices in that reality, the adjustment will be severe. Druckenmiller knows this. He has positioned for this. And the 3 safe havens I am about to walk you through are where the smart money is already moving. The first safe haven is gold. And before you roll your eyes and think this is just another gold commercial, let me give you the Druckenmiller framework for thinking about gold. Because it is very different from how gold is usually discussed. Most people think of gold as a hedge against inflation. That is part of the story, but it is not the most important part. Druckenmiller thinks about gold primarily as a hedge against fiscal irresponsibility and currency debasement. Those are related to inflation, but they are not exactly the same thing. Here is the distinction. Inflation is a general rise in prices. Currency debasement is a loss of purchasing power, specifically in the currency itself. In this case, the US dollar. When a government is running massive deficits and printing money to fund those deficits, the value of each individual dollar gradually erodes. You need more dollars to buy the same thing, not just because prices went up, but because the dollar itself is worth less. Gold, priced in dollars, rises in that environment, not because gold is becoming more valuable in some absolute sense, but because the dollar is becoming less valuable. Druckenmiller has been one of the most vocal critics of the Federal Reserve's money printing and the government's deficit spending for exactly this reason. He knows that the math of the U.S. fiscal situation eventually requires some form of currency debasement. The debt is too large to pay off through normal taxation. The only exit that is politically palatable is to inflate it away, to gradually erode the real value of the debt by creating enough inflation that the fixed dollar amount of the debt represents a smaller and smaller share of a growing economy. That process is brutal for savers holding cash and bonds. It is very good for holders of gold. Look at what gold has done over the past 3 years. While the stock market has been volatile and bonds have been losing value as interest rates rose, gold has quietly and steadily moved higher. It has made multiple new all-time highs. Central banks around the world, particularly China, Russia, India, and many other countries that are quietly reducing their dependence on the US dollar, have been buying gold at the fastest pace in decades. They know something that most American retail investors are not paying attention to. They are repositioning out of dollar-denominated assets and into gold because they see exactly what Druckenmiller sees about the long-term trajectory of the dollar. Now, how do you actually implement a gold position if you are a regular person with a retirement account? You have several options, and they each have different characteristics. Physical gold, actual gold coins or bars, is the purest form of ownership. There is no counterparty risk. You own it outright. The downside is storage, insurance, and the fact that you cannot hold physical gold in most retirement accounts. For most people, a gold ETF is the more practical solution. The two largest and most liquid gold ETFs are GLD and IAU. They track the price of gold closely. They are held in standard brokerage accounts and IRAs, and they have very low management fees. If you want more leverage to the gold price, meaning your investment moves up more when gold goes up, but also down more when gold goes down, gold mining stocks are an option. The large gold mining companies like Newmont and Barrick Gold amplify the movements in gold prices because their profit margins expand dramatically when gold prices rise and their costs stay relatively fixed. Druckenmiller's approach is not to put everything in gold. He is too sophisticated a risk manager for that. But having a meaningful allocation, in the current environment, he has indicated in his public commentary that something in the range of 10 to 20% of a portfolio is reasonable, provides genuine protection against the scenario he is most worried about. When everything else is struggling, gold tends to hold its value or go up. That is worth paying for. The second safe haven is one that requires the most explanation because it involves understanding something about bonds that most people, including many financial advisors, get wrong in this environment. The conventional wisdom about bonds and retirement is that bonds are safe. That as you get older, you should move more of your portfolio into bonds to protect yourself from stock market volatility. For most of the last 40 years, that was reasonable advice. From 1982 to 2020, interest rates were generally declining. When interest rates fall, bond prices rise. So if you held long-term government bonds during that era, they actually went up in value over time while also paying you interest. They were genuinely safe in that environment. But here is the thing that most people do not understand. The relationship between bonds and safety only holds when interest rates are stable or falling. When interest rates rise, which is what happens in an inflationary environment, long-term bonds lose value. They can lose a lot of value. A 30-year Treasury bond loses roughly 18% of its price for every 1 percentage point rise in interest rates. Think about what that means. If you have $100,000 in long-term government bonds and interest rates rise by 2 percentage points, which is entirely plausible in the environment we are entering, that $100,000 becomes roughly $64,000 before the bond matures. That is not safety. That is a catastrophic loss hiding under the label of a safe investment. And it is happening to real people right now in retirement accounts that they think are protected. This is one of the areas where Druckenmiller's thinking is most valuable and most at odds with conventional financial planning advice. So what does Druckenmiller recommend instead? Two things. First, if you are going to hold bonds at all, hold short duration bonds. Treasury bills, bonds that mature in 3 months, 6 months, or 1 year, have very little sensitivity to interest rate changes. If rates go up, your short-term bond matures quickly and you reinvest at the higher rate. You do not suffer the price loss that long-term bond holders experience. Right now, short-term treasury bills are yielding around 4 to 5%. That is a very attractive return for a nearly risk-free investment. Druckenmiller himself has held significant positions in short-term treasuries during periods of uncertainty. It is not glamorous. It does not make headlines. But it protects your capital and generates a reasonable return while you wait for the situation to clarify. The second option within the bond space is treasury inflation, protected securities known as TIPs. These are government bonds where the principal value adjusts upward with inflation. If inflation runs at 4%, the principal of your TIPs investment grows by 4%, and you earn interest on that larger principal. In an environment where tariffs are pushing prices higher and inflation is accelerating, TIPs are one of the few bond investments that actually does what bonds are supposed to do: protect your purchasing power. The mistake most people make is that they lump all bonds together. They think bonds equal safety, full stop. Druckenmiller's framework is much more precise. He distinguishes between short duration bonds, which are genuinely low risk in any interest rate environment, TIPs, which protect against inflation, and long duration nominal bonds, which are actually one of the most dangerous investments you can hold when inflation is rising. Right now, moving out of long duration bonds and into short-term treasuries, or TPS, is one of the most important portfolio adjustments a person in or near retirement can make. It is not exciting. It will not make you rich, but it will prevent a loss that could otherwise take years to recover from. The third safe haven is the one that actually gives you the opportunity to grow your money even in a difficult environment. And this is where Druckenmiller's thinking is genuinely brilliant, because he does not just protect capital. He finds a way to grow it, even when the macro environment is challenging. The third safe haven is companies with genuine, durable pricing power in sectors that people cannot avoid. Let me explain what I mean by pricing power and why it matters so much right now. Pricing power is the ability of a company to raise its prices without losing its customers. It sounds simple, but it is one of the most valuable characteristics a business can have in an inflationary environment. When costs go up, when the price of raw materials, labor, and shipping increases, a company with pricing power can pass those higher costs on to its customers. Its profit margins stay intact. Its earnings hold up. And because its earnings hold up, its stock price holds up, even as the broader market struggles. Companies without pricing power, commodity producers selling undifferentiated products, retailers facing fierce competition, companies whose customers have many alternatives, get squeezed when costs rise. They cannot raise prices without losing business. Their margins compress. Their earnings fall. And when earnings fall, stock prices follow. Druckenmiller thinks about this in the context of sectors. There are certain sectors of the economy where pricing power is structural. It is built into the nature of the business, and those sectors tend to outperform dramatically in inflationary periods. Healthcare is the most important one for the audience watching this channel. Healthcare spending in America is driven by demographics. The baby boomer generation, the largest generation in American history, is now fully in its retirement years. The demand for healthcare services, prescription drugs, medical devices, and elder care is going to grow for the next 20 years regardless of what happens to the economy. You cannot choose not to need your blood pressure medication. You cannot decide to skip your hip replacement because the stock market is down. Healthcare companies with dominant positions in essential treatments have pricing power that is essentially permanent. That is why healthcare stocks have historically been among the best performers during recessions and inflationary periods. Energy is the second major sector Druckenmiller focuses on in this environment. Tariffs disrupt global supply chains. Supply chain disruptions historically push energy prices higher because they create uncertainty about the movement of oil and gas across international borders. The U.S. domestic energy sector, companies that produce oil and natural gas here in America, benefits from higher energy prices. They have pricing power because the price of their product is set by global markets. Their costs are relatively fixed. When oil goes from $80 a barrel to $100 a barrel, their profit margins expand dramatically. Consumer staples are the third category. Companies that make the products people buy every week regardless of economic conditions. Food, household products, personal care items have pricing power because demand for their products is relatively inelastic. People cut back on vacations when times get hard. They cut back on restaurant meals. They do not cut back on toothpaste and cereal and detergent. The large consumer staples companies, the Procter & Gamble's and the Kellogg's of the world, have raised prices consistently through inflationary periods for decades and maintained their customer base because there is no credible alternative to brushing your teeth or feeding your family. What Druckenmiller avoids in this environment is equally instructive. He reduces or eliminates exposure to highly speculative technology companies, the ones with enormous valuations relative to their current earnings, the ones whose entire business case depends on a future that has not yet arrived. Those companies are priced for a world of cheap money and low inflation. When that world ends, their valuations have to come down dramatically. Many of the most celebrated technology stocks of the last decade are still carrying valuations that make no sense in a higher inflation world. Getting out of those positions before the broader market figures this out is one of the most important moves a careful investor can make right now. The practical implementation of this safe haven for most people is straightforward. Look at the mutual funds, or ETFs, in your retirement account. If you are heavy in broad technology, focused index funds, or if you have significant exposure to growth stocks with very high price to earnings ratios, consider rebalancing toward healthcare ETFs, energy sector funds, and consumer staples ETFs. These sectors have lower valuations, real earnings, real pricing power, and real dividend payments. They are not glamorous. They will not triple in a year, but they will hold their value and pay you income while the rest of the market figures out the new reality. I want to close with something personal, something that I think gets lost in all the charts and the macro analysis and the portfolio strategy. The people watching this channel are not hedge fund managers. You are not sitting on billions of dollars trying to figure out the most sophisticated trade. You are people who worked hard for 30 or 40 years, who saved carefully, who did what you were told. Put money in your 401k, diversify your portfolio, trust the market over the long run. And for most of your working life, that advice was basically right. The system worked for you. But there is a specific kind of danger that comes in retirement that is different from the danger you faced during your accumulating years. When you are young and the market drops 40%, you can wait. You can keep contributing to your retirement account. You can buy more shares at lower prices, and 10 years later you are fine. When you are retired and drawing down your savings, a 40% drop is a different kind of problem. You are selling shares at the bottom to fund your living expenses. You are locking in those losses permanently. You may not have 10 years to recover. That is symmetry. The difference between a young investor and a retired investor facing the same market crash is exactly why what Druckenmiller is saying matters so much right now to the people watching this video. He is not just talking about maximizing returns. He is talking about protecting the irreplaceable, about not putting at risk the money you spent your life building. The three safe havens I walked you through today: gold and hard assets, short duration bonds and types, and companies with real pricing power in essential sectors. These are not get-rich-quick schemes. They are the defensive formations of a disciplined, experienced investor who has seen every kind of market and knows exactly what it looks like when the tide is going out. The tide is going out right now. The question is whether you are still swimming without a suit on, or whether you have already adjusted. Druckenmiller adjusted. The smart money adjusted. Now it is your turn. If this video helped you see the situation more clearly, please hit that subscribe button right now. Every single week I bring you the clearest analysis of what the greatest macro minds in the world are thinking and doing, translated into language that actually helps real people protect their real money. You will not find this level of honest, grounded analysis anywhere else on YouTube. And I want to hear from you in the comments. Which of these three safe havens are you already in? Which one surprised you the most? Drop your thoughts below. I read every single comment and I want to know where you are at. Take care of yourself. Take care of your money. And I will see you in the next video.